Everyone, this is Akshay from PMS Bazaar. A very warm welcome to today's webinar. Thank you for taking time to join us today. Since it's our very first webinar of the year, let me begin with wishing you all a very happy new year. May this 2026 bring you with good health, steady wealth creation, and clarity in investing. Today's session is more focused on a space that is often overlooked, sometimes misunderstood, but historically, good, rich with patient investors. The theme of today's webinar is microcaps, the dark horses of Indian equity market. Over next 1 hour, we will explore how long-term value is actually created through microcap investing, through which market timing, but through business execution. Since it is the very first webinar of the year, we thought it would be interesting to begin with a theme that investors often ignore. Yet it is continues to be the hot evolving space, the MSME ecosystem. MSMEs is the backbone of Indian economy. They are the central to government's vision of Viksit Bharat 2047. They continue to be the major employment engine across both rural and urban area. They're supported by initiatives like PMEGP and credit guarantee schemes and skill development programs aimed to improving the market access and scale. But beyond policies and headlines, the real question is, how do MSME actually create wealth for investors for the longer term? And that's exactly why we are here and we want to discuss today from the experts themselves. It's my pleasure to introduce our speakers for today. First, we have Mr. Adheesh Kabra, co-founder, fund manager at Aarth AIF. Adheesh is a CA, company secretary, and certified financial planner with over 15 years of experience in capital markets. At Aarth AIF, he focuses on identifying high potential MSMEs and growth stage business backed by strong fundamental and capital promoters. What sets Adheesh apart from his deep institutional network and promoter relationship, which allows them to validate investment ideas on the ground, a critical advantage in MSMEs and microcap space. His approach to emphasize transparency, discipline, capital allocation, and sustainable growth. Prior to Aarth AIF, Harish founded Prabhat Investment Services as a and AS Finalysis Venture LLP, and also served as a director and CFO at Prabhat Financial Services Limited. Joining him, we have Mr. Rishi Agarwal, co-founder and fund manager at Aarth AIF. Rishi is a CFA charter holder, chartered accountant, and certified fund manager with over a decade of global experience across finance, assurance, and investments. He previously worked with PwC, advising multinational clients on audit frameworks, controls, and risk management. His expertise spans investment strategy, portfolio construction, and risk management, working with family offices, corporate treasuries, and institutional investors. At Garth Growth Fund, Rishi leads the investment strategy, risk management, filtering the vast universe of companies to identify scalable MSMEs and emerging growth business. His research-driven and disciplined approach aims to deliver sustainable alpha and long-term value creation. So welcome you both for this webinar. So before I could, start off with the questions, I thought, let me, wish you both a very happy new year. So before we can start the Q&A, just a random question that I want to ask is there any New Year resolutions that you had taken for 2026?
Take this.
Why?
Spending more time on the ground, rather than wasting time, hearing to noises.
Okay.
And this last 1.5 year was actually spent on nurturing Aarth as the baby. Now I can see the baby is growing and can walk on its own with processes. Now it's time to again giving some fitness goals to myself and start with my fitness regime as well.
Okay. So you're giving me ideas to ask more questions on that as well.
Market likes, basically, one has to strike a balance. So last 1 year was very much into growing Aarth.
Okay. So no, this year it's mix of art and fitness.
Yeah.
So Rishi, is there any resolution that you have taken?
Yeah, I'm actually going the other way. Fitness definitely is on the cards.
Mhm.
Uh, 1 year has been of 18 hours working periods with no Sundays or holidays. So that definitely is going to kick in. And Adheesh really inspires me. He pretty much works out 3 to 4 days a week. I've been doing 1 day a week. So I need to pump up. I'm also looking at a little bit of mindfulness because markets have been really, really noisy. And, we need to talk to oneself, calm down. I think stress management is definitely one key card on my block for this year.
Okay. So yeah, of course, just to set the tone, I've just asked this, I wish, both fitness and markets go hand in hand for both of you. Uh, my first question for today, let us start with a very lighter note. Yeah. Both of you are CAs and come with both strong institutional and global experience. So what is that transition that you made into the fund management, and most importantly, why did you choose MSME space, MSME and microcap space, and why not others?
Okay. So as chartered accountants, we are trained to, look beyond numbers. So, understanding balance sheets, looking at businesses, that is how, I mean, as chartered accountants, we have been trained. And I come from a background of stock market only. I've seen my father, starting a stockbroking firm. We have a stockbroking firm, as you mentioned. I was a director before in Prabhat Financial Service Limited. So I have, seen stock markets. I have always seen up and down sides of the market cycle, and all those things I have been seeing since my childhood. Um, so when I started my journey as into finance, I started with wealth management. So basically, I was, advising people to invest into mutual funds, doing their financial planning, and later I started investing by myself. I have been seeing this MSME space from 2012. From the very day it started. In fact, the first company which went into NSC and SME segment was from Jaipur only. That was Vito Care. So, I have seen MSME segment, this platform growing from a very niche space to this, today's when, more than 1,500 listed companies are there on MSME space. So in this journey, many times, I have done a lot of investments. I have guided a lot of my family friends, I have managed many of their portfolios. So, I actually realized that my passion lies into, basically understanding companies, reading their balance sheets, identifying value in them. And so basically, I decided that, wealth management and, fund management basically is something where my interest lies. And why I chose MSME sector, because I strongly believe the real Indian growth story is happening in the MSME space. This space has lot many things to offer, and we have not even scratched the surface. This segment has huge potential.
Mhm. So that's the reason that you chose MSME, right?
Right, right. Because actual, in mainstream, everything is available. All information is there. MSME is read between the lines. You have to understand the business. You have to, know the face behind the business, and there is a lot of value which can be which is available if you rightly understand a company and invest into it.
Okay, Rishi, if you want to add on your perspective on it.
Akshay, this is the same question we had 1.5 years ago when we went to draw our PPM. And we really spent, I think, about 6 months or two, how you should size the fund. Should it be open end or closed end? What is micro cap? Right? Definition itself of small cap has moved from a 5,000 plus crores now to almost so many companies in that sense. So these definitions, typically we are just trying to solve a problem. The problem is very simple, that you have two areas of raising capital. One is private, second is public. Right? I'm talking about equity, not debt. Typically on debt side, we have had a cycle of COVID hitting with almost zero low cost debt to then bringing it back up to quite a high cost of debt. And then on the equity side, you have private equities and public equities. Typically in private equities, one wants to look at a 100 bagger, right? One of the blue ideas, innovations. But what we don't seem to understand and realize the importance is that business as usual has incremental growth, not disruptions. So while PE is looking at disruptions, We are looking at incremental growth in each segment, each value chain. Now that platform needed institutionalization. So while you had the last 10 years where NSE and BSE both had exchanges for SME, you really lacked institution level research, the filtration, the rigor to hit the capital markets. And while Adheesh and our families were struggling through it, this was the right time because now the regulation is mature. The marketplace is mature. You have 50 merchant bankers. Every city has at least 5, 10 companies, at least 5 companies who are listed. So in this segment, promoters understand, okay, what is the responsibility of being listed? So market was ripe enough, big enough for us to start and enter into a wealth management with AIF as a platform.
Okay, so now you just set the tone of the thing. Of course, in both of your experience, like as a fund manager, decision making frameworks differ when you're investing in MSME when compared to mid and small caps. You just mentioned saying that the definition of small caps and micro caps have bit changed. So just the benefit of the investor, yeah. So how was it framework, of investing framework will differ to when you invest in a micro cap and when you invest in a small cap?
So Akshara, this question is, so one is your standard framework, which is apt for any investment, business, governance, and balance sheet. This is standard for any investment. Now, when you're looking at a different segment, you have to identify what is the white spaces or gray spaces. In MSMEs, the gray space is governance, because most are small businesses, medium-sized businesses, which cannot afford to have 3 to 4 CXOs, one for marketing, operations, and so on. But typically, you have a one-man army or a two-man army or a family which has done something for 30 years and now they're diversifying or investing into a new line of business. So that gray space, you have to identify your own checklist, whether the reason why the family or the business is raising capital is for value-add product or to finance their own, maybe a debt cycle or a cash flow problem which they are facing, right? Because eventually the capital has to be allocated towards better returns. So if fundamentally the return on my capital is about 20%, then I am well off if that stays for next 3 to 5 years. Secondly,
Okay.
because on the governance angle, because you had yourself, your spouse, or your mother on the director board, typically we are God-fearing people when our close ones are on the board, and we are less likely to do frauds or malign the book, right? So this aspect is actually not looked at all when you look at large caps. You will never have large cap companies having the board of directors of an 80-year-old mother or 60-year-old mother, because for them, the investors would say, why do you have her? Rather have a PE fund, rather have a mutual fund, right? Rather have a bank. But that's not the case for us. So there are many such examples. To an extent that we also had a criteria where whether the person's 24 hours is dedicated towards one segment of business or not. So let's say if a businessman, let's say my family, I belong to a family who have been in business for the last 50 years and we into automotive, right?
Mm-hmm.
I was also a CFO of an automotive company or handling the finance and doing fund management. You would have less conviction in me. Same thing goes when you look at promoters. Whether he is over diversified, he is diversified in businesses which have no correlation. That doesn't make sense because सबके पास 24 घंटे ही हैं. आप 12 घंटे काम कर लोगे. So you have to have that focus and rigor and you have to live and breathe that business. That is very important for us and it's actually very easy to find in MSMs as compared to Mainboard, because once you become Mainboard, you've made some money in IT, then you open a company into services, then you open a company into hardware trading, then you open a company into real estate. It's very common because you keep on moving capital. But it's very easy to find in MSMEs because we have seen businesses who have just been going in one segment, opening new lines of value. Someone started in steel, going into scaffolding. Someone started in basic casting, going into specialized casting, which is used for railway and defense. Extremely easy to find. And if they're looking for capital, for innovation, for new product, for import substitute, who better than us?
Okay, so I'll ask one question. Like you're going into the promoter's life only. So is there any
Absolutely.
interesting story that you have, if you could share with us?
Absolutely.
That you
Very,
got
very,
to
very
conviction.
recent. very recently one of a simple EPC company. So an EPC company is fairly anyone who's doing contracting, right? So Indore-based company, an EPC company, on a con call, we had the grandfather who's 80-year-old, the two sons who are mid-50s. One of the sons were in Northeast working, so he could not come on the con call, and their children. We had 8 people, 3 generations on one video conferences. And we could see that whenever we asked any questions, sometimes the grandfather answered in a very typical way.
Okay.
I have lost some money in COVID. Now I want to do things this way, and I want to consolidate all businesses. I want my third generation to be professional, and therefore we're doing XYZ. The third generation doesn't overstep and answer back when a grandfather or father is answering. That shows structure, which is
Yeah.
important in any organization. The CEO is speaking, the management should stay shut, right? And let the CEO complete. And the mid layer of the organization were on ground. They were literally going on field, spending time on projects, be it a toll project, be it a project in Northeast. So Indore-based company delivering project in Northeast. Same
Okay.
example we have seen in Delhi NCR company delivering in Guwahati, right? And recently we saw how chicken neck of India is so vulnerable to the entire Bangladesh and China inclusion, which is your Guwahati belt. If you don't build infra there, who will? And I bet you not L&T, CXOs will not build it infra there. It will be the MSMEs who will build infra there, who will build roads there, who will build security there. So you need people on ground. And the bottom layer was simply saying, sir, we are learning. A 25-year-old, हम तो सिर्फ सीख रहे हैं, parents. And they had decent education. They were from finance background or engineering background. So background helps. So this structure, you can't buy this. If I had to buy that entire family structure, it would cost me at least 15 crores to buy all 6 of them and tell them कि 10 साल आप इस पे काम करो. And I'm getting it passed as part of the equity, right? So
Okay.
these things you can't really value in terms of words. If the entire family is involved, all eggs in one basket, I am secure that they will not venture out into something which they definitely lose money on, because they will find their way to mitigate their risks.
So these are beyond numbers, actually. This cannot be
Beyond
quantified.
numbers. Absolutely. Conviction is beyond numbers, and this helps you bring conviction.
That's very true. And of course, I think I can get more interesting stories, more different, business ideas. So that, comes from MSMEs. And also, as a sector, let's talk about a bit macro. As a sector, what are the headwinds that because we are in the beginning of 2026. So is there any headwinds that you foresee for MSME in this calendar year?
When I look at MSMEs, I simply consider the word as new businesses or businesses which require lesser capital than that of, let's say, Reliance entering into telecom, right? Me Too is the biggest risk. If you're trying to copy the last trend, you are at much higher risk because the alpha of innovation is gone. So,
Okay.
for example, and I'm not quoting from my fund perspective, but individually, I have seen from the circles of investors that someone who's entering into, let's say, solar module manufacturing now might not enjoy the margins or the payback period of their project which someone enjoyed 5 years ago. So
Okay.
anyone who is coming to capital markets or raising capital privately or starting business from his own savings, the logic is same. You need to create alpha as a business by the strengths you have as an individual, as a family, as a location. So someone placed in Mumbai will have a better chance, let's say, of starting a consulting firm than starting someone in Bhopal, right? Because the market is in Mumbai where you can serve services. However, if someone is starting, let's say, Odo, which is an ERP platform, is started in Gandhinagar, an IT company, because he saw the attrition rate is much lower than that of Bangalore, right?
Okay.
Or that of any other IT city. So you have to really identify what will work for you for next 3 to 5 years. And for that, put your own capital, take some capital from your friends and family, a PE investor, and then come to capital markets.
Okay. When you say that,
And you need to,
sorry.
You say something?
No, I just had one question when you, asked about the innovation. You told about the innovation
Yeah.
part. So,
Yes.
after 5 years, today's innovation would be old. Correct.
Yes. Yes, and you should typically avoid entering into a bandwagon. So for an MSME, you have to be on your toes and keep looking for disruption.
Okay.
Right?
So
The biggest headwind is coming from a fact that people are looking, अच्छा वो company list हुई थी 6 महीने पहले या साल पहले, वो क्या करते हैं? They are doing solar module manufacturing. They are into steel business. They will put up a solar manufacturing plant and then raise capital. Won't work.
no.
That story is gone. You're definitely going to face headwinds because the margins are squeezing. There's a pay derating happening. There's a liquidity overall at a macro level. You're seeing more supply on paper. So, headwinds point of view, there is more supply on paper definitely. Second, there is geopolitical risk overall. So there's a supply chain disruption, right? And that also leads to opportunities because there is supply chain disruption. Are you looking at areas where there is import substitute? Are you looking at strategic industries where there has to be non-stop supply,
Mm-mm.
right? Because country has a risk of shutting down if things are not diversified enough. So if you are entering into these spaces, it totally works.
Okay, like you spoke about a lot of sectors now. So let me ask in this current market, at this point of
Okay.
time, what are the sectors that are, performing well in that MSME part?
So we are typically sector agnostic as a fund, right? We have zero bias. And time and again, I tell my analysts that whenever you're looking at an EPC company, please don't be biased that EPC hasn't done well in last 1 year or solar manufacturing hasn't done well. If someone has identified a target market, is able to pin down on the margins they will enjoy, and that is making financial sense, please look at it independently. Having said that, a few sectors do come to your mind because there's a big gray area, right? There is actually a big white space. One is precision engineering. We have had times where everyone was importing capital goods. They were importing design, technology. If the engineers of India, which they have started, are on floor of the plant, building their factories, understanding material, understanding what design has to be put in for a product, and building right quality engineered products, because eventually we are all looking for long asset life, be it in shipbuilding, be it in defense, even cars, right? Eventually, you owned a Mercedes because you knew 20 years it won't go anywhere. Volvo used to be last 30 years. Now you can't last a car more than 7 years. So precision engineering is one space where we're looking at it. Then with that engineering, IT has been on a headwind for last 1.5, 2 years, more so in last 1 year. We will see a revive back because the entire space will find offshoot where Indian talent backed by innovation with some country or asset or hardware by some country will unlock value just the way we did in last 30 years. So in every space we will find value. EPC, we are looking at EPC as not doing well because if you see the latest report of economic times, only 60% of capex which was planned by the state governments has spent in last 9 months. So
Okay.
40% has to be spent in one quarter, which is Q4,
So
right?
Q4 will be
And
good.
we are seeing 2028 be election year. So whatever the governments have to do has to be done next 1 year. Everyone wants votes, so we will see a public push. The only issue is that they have to manage the balance sheet. So the country also looks at the balance sheet, which they have trimmed with the GST cuts, with the income tax cut. But then consumption kick in. Consumption stories will play. So you have every aspect where stories will play. Criminalization. Today I'm using a mic. I'm using an earphone. I bet you 3 years ago I never used a mic. I would typically go on a laptop or maybe wear a wired earphones because we are all upgrading. You are using a fancier mic than me, which is like a branded one, right? So this is all consumption, and we are ready to spend more if it is giving better experience and lasts you for a while.
Yeah, but the sector that I had in mind, but you might take it out of is what AI. I thought you will talk about AI as because innovation doesn't seem same. It doesn't seem the same year after year. So, but you never took that. Is there any reason?
I don't, because these are all tools, right? In fact, today we are looking at a pipeline of 250 companies in DRHP. We're looking at 85 companies were approved for listing. So just yesterday we sat with a team of 15-member team, the only analyst, and we're looking at यार इतना सारा कैसे फंक्शन करें. So we are using AI for making summaries of DRHPs. So we've defined a few prompts that वो 400 पेज को कैसे 40 पेज में करा जाए. You know what questions you want to answer to, how that PDF can convert to an Excel for financials. So that is, I think that is just pure innovation at an institution level, which you have to do, be it enabled by AI, be it by cloud, be it by better UX. That is up to you. In my organization, we use MS Office for everything. Today, if my laptop crashes, my touch wood, anything burns down, I'm one click away. I open a device, put my phone number, put my OTP. I can log into my entire ecosystem of Earth, and my team can do the same from anywhere. So we have all moved to cloud, and cloud with 30 years से cloud होगा, cloud होगा. Cloud से कुछ नहीं हुआ. Things became more accessible, more secure. Along with that came cybersecurity as an opportunity. So now you have cybersecurity. So AI for me is just another tool for the larger industry space to be more efficient and increase the per capita productivity as a country. And because we have the best demographic, if we adopt it at an individual level, organization level, state and country level, we'll have the highest alpha.
Okay, I think that's given a more of positivity for the Indian market as such in 2026. Of course, Adhish, to you. So, do you see the MSME investing, moving closer to this, private equity space or remaining with this public market structure?
Right. So what exactly is MSME? It is nothing but, private equity in public space, right? So, I mean, it would be not nice to say, but if we move towards private equity again and not towards public market, we'll basically go 12 to 15 years back, because 2010-12 was the time when actually private equity, venture capital, and all these things peaked out, and that was the time when MSME was started. So there must be some thought behind it, and the regulator must have thought that to bring private equity in public space, the very objective was that, when promoters who were never been of capital raising was difficult for them, such promoters who have good businesses, profitable balance sheets, a track record, a pedigree of 10, 12 years, doing proper businesses and having good business ideas, they get a platform wherein they can raise capital and can start their operations, or they can, just boost their working capital requirements. And that was the reason. So if we again move it to private equity, and it would not be wise to do. And I strongly believe that SME is the flavor of the investors. If December month itself is a testament to that. If you see, there were 3 IPOs wherein the investors gave bumper response. We get highest subscriptions starting from Exato, 23,000 crores, Shamjani Masala, 25,000 crores was raised, and today listed company E2E got 29,000 crores of subscription. So this is the kind of confidence and participation you can see into MSMEs, which is going forward. And definitely it is basically the flavor of the investors. So I strongly feel that this platform will evolve and will grow way, way, way far.
But true, of course, it would. But as we talk from the investors' lens, yeah. So many MSMEs rush to IPOs to raise the capital or to provide exits. So how to differentiate between the business that is very much IPO ready or was just IPO aspirational? So how do you differentiate that?
So, forget IPO. Raising money is any entrepreneur's
Yeah.
favor, right? Be it you, be it me. I would love to, let's say, come up with an IPO at some time and raise money. But the point is, I have to first prove to myself or convince myself that yes, I need to raise money because, and I need to raise money from dilution of equity. I could raise money for debt from internal accruals, and then math is very simple. right? Debt comes at 9 to 12%. My accruals is dependent on my projections or budgeting. Equity is something which gives you that kick of growth through capex, through working capital, through investment into R&D, which very much should pump in India. I want to see many use cases in my DRHPs where I say R&D spend 2 crores.
Oh,
And the reason my promoters are shying away is because then they have to prove it to the regulators, to exchange. कि मैं क्या R&D करूँगा? So probably that's why they don't write it. Okay. So coming back to the question, one is any day IPO ready if they can simply put the math that the money they are raising will come back to balance sheet in 3 to 5 years. It's simple project financing. When I'm raising debt, I know that with this EMI, I can pay the debt back and still have a yield of X%. If that math can make sense, you're ready for IPO.
okay.
And if today if you are stuck at a 6% growth and you know the industry is going at 8%, and you can somehow figure out the right method of capex and working capital and the spend on human resource and define it to a 70, 80 crores and say, okay, if I raise this money, I dilute my equity and I can grow at 18%, which is 2x the industry. That totally works. Because in any industry, you will have consolidation if the industry is stagnated. And in an industry which is growing fast, you'll have disruption. Someone will do it better than you, faster than you, maybe using AI, right? Maybe using robotics. We have companies who are we are one of the companies who's actually into robotic welding. So 80% of India welding. So 80% of the welding in India is done by hand, right?
Yeah.
So welding pe wo khurdurapan aata hai na, when you see the welding, it's uneven. In automotive, you need welding to be precise. Because if you don't do that, the movement of the parts will have friction and that will lead to inefficiencies. So robotic welding is actually a huge space which is ripe for disruption. And right now, up until 3 years ago, we were only importing robotic welding machines.
Okay, I think that's something new.
Yeah, Wipro has a very big arm called Paras Robotics, which actually supplies 80% to Europe.
Oh.
We don't know that part of Wipro. We only know Wipro as part of IT company where someone's sitting in Nasdaq ringing a bell and doing some IT services or maybe a bulb or a hardware. But that's the game. That's the game. You really need to see whether that fits. And if the promoter has identified, okay, sir, I can do this in India. I've done this in India. I can supply to these players who have a use case. I need to raise this capital in 3 years. My money is free. It is total sense. Makes total sense, right?
Yeah. So like, of course, in the conversation getting more interesting, but let me, request the audience or the people out there in the call to, ask more questions on the podium. So even those questions will be answered by the fund managers themselves. So moving on to the next, as we just started talking about IPOs and all. So where is the maximum value created? Is it, is it before the IPO, by the scaling time? Is it from an investor perspective, where is he creating the value? Is it before getting listed or it's after getting listed?
So in fact, value creation. So look, return and risk have to go hand in hand, right? For someone who is a PE fund or a PE investor, you would say, I have made 1,200 times money on an IPO of Grow. So I have a family investor who's invested in my fund as well, who has put the first 1 crore check in Grow. Now it's 120 crores, right? Or I think 1,200 crores, I don't know the number. Having said that, he would have put such checks to 100 startups which never came to light. So you might have created value on one. Therefore, so typically you should actually talk about risk and return, which is what all returns should be spoken to. Risk reward ratio is what you have to look at. If you're able and you've sized your risk capabilities, risk appetite, and with that you benchmark your return, is what you should look at. When we're looking at MSMEs in capital markets, we are mitigating the liquidity risk you see in pre-IPOs or PE funds. Because every day there's a screen, you can exit, you can enter, which you can't do into pre-IPOs. right?
Okay.
Having said that, the same can be said by a large cap fund manager who will say, I can sell 100 crores of money in one day in a script. Where you can't do that because the market cap is 1,000 crores, right? So it's relative. So value unlock can only happen with the entry price.
Yeah. Right.
What value you put to the company with the projections of next 2 3 years, and that's how you unlock value. That could be 2x, 5x, 10x. Nobody knows. It's your assumptions on intrinsic value of a company 3 years from now, and that can be a combination of the business, the promoter. For us, it's actually promoter business fit, whether the business works. Many a time we have seen promoters navigating and changing the entire business model and still make money for us in 1.5 years.
But that's a
So
red
a
flag, right?
service. So if you've tried for 1 year, let's say a service IT company started 3 years ago. 3 years ago, IT service was in flavor. That basically meant I would go export services or products, right? Now that company has moved to a product company because we realize now services is actually got disrupted because first expansion, second reduction of price by all these big service players, and AI. And also you had a decrease in spend of IT at a global level because you were seeing a lot of layoffs. So what do? You then identify, okay, where were they providing the service? Can I build a product in that aspect, and that product becomes scalable? So are you looking at disrupting your own business because someone else is disrupting it? If you're open to that, totally works, not a red flag. Obviously, if an IT company starts a food company and says, I'm going to give you chips and doklas, that definitely is not making sense to me. Unless there's someone like Theo Broma who left their job in Wall Street and came back and made cookies and still made a hardcore brand, right? So, but then you have to leave your job at Wall Street.
Not many would prefer that. Not many in that space. So of course, I'm getting few questions from the audience. So I'll take the one. So that's a direct question to Rishi. You specialize in pre-IPO MSME or listed MSMEs, and why? I think you've already answered, but if you want to add something to it.
To put to perspective, we are a Cat 3 fund. And we chose Cat 3 because we wanted primarily to be in public markets. As a Cat 3 fund, I cannot invest more than 40% in unlisted equities, right? At a fund level, we have kept 20% as a benchmark. The reason is very simple. We are a 5-year closed-end fund. When we have 1.5 years to deploy our money, from a time of deployment till a point of exit, I need to look at where all there is a demand supply of script and value unlock in the business model. So typically, I would do pre-IPOs which have a clear exit for me in 3 years from now. That is a must. Second, whether a similar business line of business or a similar return is available to buy on screen. If I can see 3x money happening in one script and I'm looking at similar returns in a pre-IPO, then I would rather not do the pre-IPO. And third is the entry price. I'm getting a reasonable entry price because of the liquidity premium which comes at pre-IPO, which is 30-40% below the screen. And it is only a construct of someone's got an order and they really need capital and they need long-term institutional capital, which is provided by us. Then that works. So we have in our portfolio 15% portfolio is pre-IPO, which is unlisted. Balance everything is listed.
I think there are a lot of
And in the
questions.
500 crore, it makes sense.
I think there are a lot of questions about your fund, which because I cannot take it because that can be answered offline as well.
Right.
So there's one follow-up question to it. It's like as we're talking about it, what are the as a fund manager, and when you put all 16 17 hours into your fund management in your life, but as an investor, we cannot spend so much hours in research and development, this research of this particular space. So what are the mistakes or investors should be aware of while investing in these microcaps?
Adheesh, you want to take this? Because you made some mistakes yourself.
Any
No, Adheesh is good because he's been an individual investor. He's invested for his friends and family, And now he's always had an institution, and he's built up institution last 1 year. So he's made a few mistakes which he's not making now, and there are some areas he cannot do because he's an institution, and those go beyond the risk management framework. So he really has felt it and lived it.
So I think from you directly, I think like you're the best person to talk about this.
And so I'll say, see, investing, many times I feel retail investors invest just into IPOs specifically, just by seeing the subscription numbers. And I think that's the last thing one should do.
Okay.
So, seeing the gray market premiums and, subscription numbers, basically all those who are investing by, these yardsticks are doing nothing, but they all are not investors, they are flippers, basically. Possibly a good company, good fundamentals can get a good subscription number also. So your reason in investing should not be, by on the basis of subscription numbers or gray market premiums, because all this is a market, where there are merchant bankers and investors and promoters, so whenever a company come up with the IPO, merchant banker takes the mandate and brings the IPO into the market. There are a lot of gray market premiums, other presentations, road shows, many things happening. One should look at the fundamentals of the company, the balance sheet, P&L account, and in case of SMEs, there is lot into deep diving into the actual business, what promoter is doing, how much TAM that particular sector has, what are the tailwinds, what are the headwinds. You need to understand all that. Then only you should invest into the business and invest for a long term. Don't just flip on ideas. Don't just make just flipping your capital by investing into one company today because it has got subscription, then selling it on listing gains, or not getting the listing gains, then buying something else. Study the company and stay invested with that. This is what I have learned in my journey of 15 years, that fundamentals and numbers, price will always come.
Okay. I think that was answered. And I'll take question from the audience as well. That's a question. How do you think about lack of liquidity in SME space? And also, how do you think the risk in SME investing where there are lots of unknowns?
So you start knowing the unknowns. Basically, that is one thing. You don't invest into if you find many unknowns. If you see a lot of red flags, why are you investing into it? One should actually read the company. These are investments. See, a lot of retail participation is coming, institutions are coming, but a lot of study is required. Just joining a WhatsApp group, seeing the gray market premiums will not lead you anywhere. So if you talk about the liquidity and from a fund perspective, it is very important that definitely the first thing which we look before investing into a company is how we will exit from this company. That is the key point which we look at, because if we do a good investment, sizable investment, and the value also goes up, our portfolio increases, our NAV increases, and finally we are not getting an exit, it will not make any sense. So not boosting, but from in our fund we are very particular about how we will exit. And in fact our entire portfolio, whatever NAV it is today, we have a good 65-70% of already booked profit is there. We go on churning our portfolios. We invest into a company with the idea that we'll be there either for a number of with a price target, or for a time horizon. And if the price comes, then we do exit. So
Okay.
basically, liquidity is a problem. Definitely, it's a problem. So you cannot invest into a company like you have invested 15-20% into a company, which have scarce liquidity, and you expect to, liquidate your entire position in a month or a week's time. So we do a lot of stress test also. So I think if the question is from the fund point of view, we do take care of liquidity risk and invest accordingly.
Okay. So you were talking about exits. So what are the checklist of parameters that you look into before exiting? One is liquidity. So others?
So typically, in fact, there are 5 parameters for exit. One is when we are entering, we have to be reasonably sure of price and time of our exit.
Okay.
Second, Adheesh has had about 10-15 years of experience on screen, and we are one of the few funds who actually trade ourselves. We don't email anybody. We trade on the screen ourselves, block by block. We know how much depth was there at what script. Third, in MSMEs, you have to look at PE fund, right? For example, if you were to look at OYO 3 years ago, you would not buy its shares in in markets. Today, I meet some investor and they said, I bought OYO shares, I bought NSE shares, right? 3 years down the line, OYO has completely changed. They have repositioned, they have EBITDA positive, they're cash flow positive. I personally know the treasury head of OYO, and he is very happy now from what he was 3 years ago, right? So you have to also time your exit when there is momentum. Momentum is backed by events and by earnings. If when investing, you're fairly certain that these earnings are expected, there can be a lag of 6 months, at worst 1 year. But if directionally the company is moving there, you don't have to really press the button every day. Point number two, we are not the sole investors into a company. A SME IPO requires 1/4 of the dilution, 25% plus approximately, right? I cannot hold all 25%. I need fellow investors. We're a community, right? So if there is a buying spree and there is a interest by a few investors who have now got the story of a company which we got 6 months ago, we should allow them to participate is what Adheesh meant by stress testing. We actually let go of some of our position. Let's say we have sized up 3.5 to 4% of a company. We are okay to let size down to 0.5% or 1%, because a new investor brings in new enthusiasm, a validation to our idea. Similarly, if people are losing interest, because let's say someone thought that, oh, I should have made 2x money in 6 months, I'd not make it. Let's sell it here. I've made 50% returns. An SME should get 80% returns. Example. We understand 80% return is unreasonable and unacceptable. And if the company is good and we still expect an upside, we will keep on adding on to it. And with this discipline is why where there's a bearish scenario where you've seen overall markets, mutual funds doing 10%, markets doing negatives in a way. We have done fairly well, about 2.5 to 3x of the returns. So because neither do we live with FOMO, and nor do we be scared to exit now and might miss the upside, because there are many ideas. We are very, very happy that we have 250 plus IPOs expected to come next year, because we can be choosers. The issue will actually come when you have 50 IPOs, 100 funds fighting for the same piece, right?
Yeah.
So you better off be choosers. Better off be choosers.
Yeah. And now that we spoke about the fund as well, let success story, everyone knows. Everyone falls for success stories, but it's very rare people talk about the failures. Of course, all of us are humans at the end of the day. So is there any, script that didn't work for you? That becomes a lesson. So if you want to share any of your lessons with us.
In fact, actually, many a times the upside become a lesson.
Sorry?
An upside becomes a lesson for you. So you've seen most investors, you would see it. I really watch a lot of videos because I'm someone who consumes content in video format. I've seen most people regretting the upside. Someone talking about Enterloan, someone talking about HDFC, someone talking about Airtel. And these are people who are better in the industry. They're never afraid of downsides, because that they have exited and they will exit. And they know what downside they are. And you're entering, your downside. So as a fund, we started the fund, we knew that we will have 60% hit ratio. We should have that. That's our target, right? If 60% of my bets become 3x to 5x, my returns are sorted. I should not spend a lot of time on the 4 I did not make money on, because if the fundamentals are not moving in the direction because the industry moves. So, and funnily enough, we have in the same sector, we publish a newsletter every 6 months. In the next newsletter published, which is going out for printing now that New Year is off, we have really seen that what we published 6 months ago, in the one page, we had 4 companies from the same sector. 3 have done really well, 1 have done half. Right? The entire, and that is true. Why? Because one doesn't know that when the growth kick in, right? That nobody knows, because there are so many factors, macro and micro factors, which help you kick in that growth. So now we have learned with investing over 80 ideas in last 1 year, we have learned to never look at our losers only for lessons. We should look at the entire sector, the thesis, what checklist we had while investing. And one of the biggest learning is the only thing in your hand is your entry price. If you get your entry price wrong, you will have a long holding period, you will have a very low upside. And the second lesson we have learned is that we should let go of our winners to a size where it makes sense for the entire market. Because if you have more people who have ruled the curve, let's say we see the America story, right? America story worked for 30 years. But every year we see some funds going bankrupt, some new funds coming in. So we have to participate and let others participate. In IT, we have had very bad losses. We have had great winners. In energy, we have in battery, we have made 2 companies who did very well. One didn't do so well. In infra, we have seen a few EPC companies who've tripled their order book in 8 months.
Okay.
Tripled their order book. Obviously, the size was small. And one company which has gone 20% only, but their cash flow become positive. And that price didn't move much, right? Because their aim is to become cash flow positive, control their receivables. We have seen segments which had very good spend by the government being brought back. We have seen the entire water EPC space, which was not paid very well by the government, but we are expecting that the space every day you news, and then not today 150 people died because of contaminated water. You have to fix it. Delhi for last 2 months is stuck with pollution. You have to look for control on pollution. You have to give basic utilities on energy, on water. The cycles will play out. Whether the promoter is right fit, whether the state which you're in has the right demand, whether you can execute well and collect money fast.
Okay. I think that's a good take for today for people, investing in microcaps. So I'll take one question from the audience is that Shiva has asked this, that do the prospects for the MSME change abruptly due to geopolitical tensions and increasing of AI tools? And again, this question, what are the prospects for MSMEs in manufacture of weapons for armed forces?
Wonderful. I'll take the first one first. Typically, MSMEs are enablers to exports, right? And thankfully, because of COVID, every MSME has now diversified their portfolio of exports. Okay. So I stay in Jaipur. Jaipur had great jewelry and textile, little bit of it. In last 3 years, I have seen they have gone from 1 country export to 10 country export. So yes, there's no doubt about it that geopolitics does impact the entire problem statement by the American raising tariffs has impacted us because MSME is eventually part of the entire supply chain. Whomsoever they are supplying to, if they get disrupted, even they get impacted. But when we invest, we typically don't invest into companies who have more than 50% concentration to one geography or one buyer. Because concentration is something we can't avoid. And for our portfolio, we are fairly diversified so that this impact gets mitigated. So as Adheesh was saying, that we don't put 10% of our capital in one company or 5% of our capital into one company, or we don't go with the philosophy of holding only 20 scripts or 30 scripts, because eventually risk management is our primary job.
Okay. And there was one question, because you're talking about scripts, I'm asking you, there's one question, which I hope I just missed, asking how many scripts that you hold in your fund, if you want to answer that. So
the number of scripts is not important for us, because as a fund, we have 2 books. One is the investment book, another is the prop book. In investment book, we have different thesis and strategy of investment, what we keep, for how long, what price and lock we have, and that's something which internal metrics. So typically 30% of our book is prop book, where we are not able to size or only size basis permission adds. If there's no permission addition, we exit those scripts. So in my strategic book, I have roughly 60 scripts.
Okay.
In my investment book. And in that 60 scripts, some can go out, some can come in, like in the rotation. And that we look at every quarter. And we keep that number fairly. We are into a high voluminous space. So you have to understand that we are not a large cap fund who has to bid at Nifty 50. Right? Our benchmark is typically a NSE 500 or a basic 50. So हमको तो 500 देखनी है. So we can't get biased because our benchmark is not concentrated, neither should we. And if we don't mitigate our risk, the entire return will wipe off.
But your churn is quarterly ones, correct? As you mentioned.
No. Churn is not quarterly. We relook our segmentation or our thesis allocation to a script quarterly once.
Okay.
Because before the quarter, we don't get results. No, in SME, we get 6 months results. In Mainboard, we get 3 months results. Right? So typically, quarterly is where we get understanding. We meet the promoter, talk to them, we see their sector. So we have about 15 analysts in us. Once in a month, we talk to someone or the other. At least
Okay.
the company, which are 60 companies, we talk to them once in a month, no matter what.
Once in a month.
Once in a month. One of my analysts has spoken to them. We know exactly where they went out for the New Year's. We know exactly if they are going for their anniversary or something this year.
That's nice, actually.
Right? Typically, when the IPO comes, for the first 3 months, they're exhausted and they say, I am taking a break now. IPO is very stressful. So many investors meet. So many things you have to manage for the first time. And they all take a 2-3 day break. So we are there. And we actually talk to them way after the IPO frenzy kicks out. Because that's when they have time. That's when they can really talk to us for a longer period. They can share their insights. And many times we meet promoters meet each other. So one company who is making battery for laptops, another one who's refurbishing laptops. We tell them, why not talk to each other? And they've got supply match.
I think you're developing the business only. It's just that funding them also.
We are 1 to 3% partners, yeah. So we have to do our job.
That is that. And I'll just move to the next question because time was always a matter. Mihul is asking, can you share your insight on Anchor Book? Is a must to be completely subscribed or not necessary?
Once a IPO has a QIP, if it is a book building IPO and there is an anchor portion, it has to be subscribed. There is no option of not subscribing it.
Is it necessary to be fully subscribed? Is what I think his question is. So I'll just move on to the other part. How many? Of course, you've taken that. How many questions? I mean, how many scripts is that?
So typically, in case of the number of scripts, basically you can say like first 60 companies, 50, 55 companies account for our 75% of the portfolio.
Easily.
Oh, got it. Of course, people are asking for the recording already. Yeah, of course, you will be getting the recording post this webinar. I think it's a very interesting one too. So just let's take a bit of break from the funding. Let's jump into your personal part in the sense fund managers, of course, is quite stressful work. So there must be a break at one point of time, as in fund manager that you might take. Of course, when we started the webinar, Adhish just mentioned that he's a fitness freak. So what keeps you, mentally and physically fit, to run in this industry? Adhish, you can take it up, please.
So basically, I'm a passionate triathlete. So I do running, swimming, and cycling. So that is one thing where I put, burn my calories. And I play tennis also. And for mindfulness, I do a little bit of meditation.
Okay. So, Rishi, you?
I like long walks. So I'm a person of nature. I've not done it for a while. This year I've also made a commitment to myself that I'll do a small trek of 5-7 days. I've done a few back in my school days. Really cut off from the internet, just be close to nature. And just yesterday I started to having my phone be on a sleep mode for 9 p.m. up until 8 a.m. So if I get any calls, they automatically get cut. I don't get a ring. And that sort of gives you a break off screen because our work is a lot of screen and a lot of sitting. We would like to meet every promoter, but it's not fairly easy to travel so much.
So it's like
screen time management.
No, it's like you're telling all of us in the call, if an investor or someone, even promoter is saying that after 9 p.m. Rishi is not available. That's just sleep.
Typically, I'm not. I only have a few numbers. So I'm away from the phone. So I don't sleep that early. I sleep by 11, 12ish. But that's the time I want to spend with the family. Playing a Catan or a sequence or a card game or Ludo is what we got recently. So we want to go back to basics. It really helps you become off of what you're doing, and like life is more meaningful than what we're doing. I'm sure it does have more meaning than doing some mundane things.
Between 2023 and 2025, there are a number of mainboard IPOs, I know, in India has significantly increased. Correct me if I'm getting it right. Around 60 listings in 2023 and about 90 listings in 2024 and over 100 mainboard IPOs in 2025. At the same time, several companies have given a good competition for the listed MSME platforms. Do you think it is genuine enough to go to the main board IPO directly than skipping this SME IPO part? Adheesh or Rishi, any one of you can answer this.
If a company is coming up with an IPO of, let's say, 150 crores to 400, 500 crores, so they usually what they do is now, their first step is to do a pre-IPO. So for them, raising money through going through by a SME IPO, rather than that, they go for a pre-IPO and they take a decent amount of capital required for their working capital or next expansion, whatever. And then after a year or two, they come up with a main board IPO. And one more point here we would like to understand, I would like to bring into notice. Basically, the process of getting a SME IPO and a main board IPO, the regulator has become so stringent these days. In past, many SME IPOs have come wherein, many questions have been asked, about the scalability of the business, the very existence of the business also. So, the process has become so stringent that, many people are opting for a main board listing rather than a SME. But what exactly is happening is the first step. Usually, what used to happen, a company who wants to have a market, whether who wants to enter into equity market with a market cap of up to 250 crores or 200 crores, they do a SME IPO. They built on their balance sheet business and all these for 3 years, and then they go for main board. Basically, they migrate to main board, and we have seen good 600-700 companies migrating to main board from SME, both from BSC and NSC. But these days, what is happening is people are seeing these 3 years or 2 years, they do a pre-IPO. And so for them, that's the SME listing. And then they are in private space. And these days, in fact, many companies, we can see Vari, Vikram Solar, many companies, I should not name here, but there are many companies, their shares trade in secondary market. And after 2-3 years, they come up with a main board IPO. So typically, what they would have done after 3 years migrating to main board, they do a pre-IPO and then directly go into main board. And one reason is this also, that the process of getting listed on the main board is these days have become easier. The requirements have also become easier. Nowadays, for a SME to come up with for a company to come up with a SME IPO, they need 3 years of positive balance sheets, N number of profits, top line. Many things are there, which is not in the case of main board.
Okay, so that's easier way to
So
go.
it's like migrating to main board is more difficult than actually coming for a main board IPO. If you look at
Exactly.
regulations, and that thing merchant bankers will tell you, and you will see the entire ecosystem is obviously developed by the regulators, enabled by the players of promoters, merchant bankers, and investors. We are just consuming it. So when I look at a main board IPO, which is at a 27 or multiple, I would see a similar size of company available at 15 multiple on SME. Now someone has to justify it to me, why should I pay 2x? For what am I paying 2x? For the tag of main board, for the liquidity it brings to me. I am okay. I am an investor. I am okay to hold for a country which is going through a growth story. I should have at least 1 year vision. If I don't have an appetite for a 1 year vision, then there's something fundamentally wrong. And we have seen many cases that promoters have said, sir, we are not going for SME IPO because we are capped at a certain pay with when we were cutting for an IPO, and we know that the valuation which we should get is so much, and I'm getting more in pre-IPO. These 5 investors are ready to put 20-30 crores. Why should I go for SME? Right? So the entire ecosystem will maneuver into a direction which is most efficient for the business, and be it main board or SME. For us, it's microcap. Below 5,000 crore market cap is our universe. We're a 500 crore fund. We're a closed-end fund, fully subscribed. I think barely have 10 crores left to subscribe to. We know where we want to invest in. We have complete visibility on next 6 months of investment. We have spoken to 30 merchant bankers. We know their pipeline. And we know exactly what we will do in coming times. What we don't know is how the screen will behave. And that is the only dynamicity we work at. And obviously, nobody knows what profit will come because profits can erode or double on the market sentiment. Everything else is what we are fairly aware of, and we are also building our own processes to become more efficient, to have more coverage, because as merchant bankers are increasing, as the plan paper is increasing, we also need to become more efficient to quickly identify companies, have a mechanism to filter out much faster.
Okay. So thank you, Rishi. Thank you, Adheesh. Like I think we have, we have come past 5-6 minutes for the webinar. It's supposed to be 1 hour webinar, and still I could see more of questions, and still people are, putting more of questions into it. I don't think so. Everything would be taken, in
Just send
time.
us the questions on the email, Akshara. We will
I-
have them answered, maybe 5 questions a day or 10 questions a day. We don't want to leave anyone unanswered. I understand this space is fairly uncovered, even at the asset management front. And we would like to answer as many questions we can answer with the confidentiality we have to take for investors. So we'll have that sorted for you.
Thank you, Rishi. But before we could wind up, is there anything one thing that you want to say for, because we're just in the beginning of 2026. Is there anything that you want to say to the investors who are looking forward for this year? One liner.
So I think 2026 is the year for Southeast Asia. And we are seeing the power shift moving. And bet you not, in 10 years, we will see a powerhouse out of Southeast Asia, and it should be India. It makes all sense demographically, politically, even from the point of view of efficiencies, we are rightly placed.
Okay. Adheesh, from you?
You invested with your conviction.
That was very short. Thank you. So thank you, Adhish. Thank you, Rishi. So I'm wishing you both again a very happy new year, and looking forward for Aarth Growth Fund coming up with it. Again, I guess it's coming up with a second fund as well. So looking up to it. Thank you all. Thank you, participants, for being.
Thank you all. Happy New Year, everybody.
They're in short.